do the first part of it in so for these the practice exam, we'll do these first two first, the tough ones, and then we'll go into problem 3, which is basically the for individual transactions, doing the journal entries for those. And that'll be it. We're not going to go into chapter 8. I was going to do chapter 8. Chapter 8 is kind of a can of worms. So I'm gonna hold off on that. And next week, oh, I didn't tell you guys this. Next week, no class. We're on spring break. So what I'm going to do is today we're going to go over the practice exam. That's gonna be it. If you guys want to take it in the classroom, I can print out the test and do it in class. Or if you want to do it, if you want me to send them to you, that's fine too. Either way. And let's see. Yeah, and the rest of you guys playing at home, they will be sent out right after class. They're ready to go. They are due on, I put it after the break. I think on Monday the 9th is when everything is due. So I want you guys to take your break and not think about this class. I don't know what your other classes are doing, but don't think about this class. And anyway, so the practice exam will be similar to the exam that we're going to have. And we're basically going to do the current method, the temporal method, and then do the transaction. And that'll be it. Okay. So let's go ahead and get started. I'm going to do it here. Okay. And I didn't put this thing on the practice test. I don't think I put it on the regular test yet. I could tack it on. Maybe I'll do that. I'll tack it on to the actual exam when I send it out. But I didn't put it on there just for the kind of spacing of it. Okay. Okay, so the first one, this is the functional currency is in the foreign currency. So we use which method? Current. Yep. So we'll be using the current method. All right. So let's see. So I'm going to highlight the current method. Actually, I won't highlight it. I will hide the other stuff. Okay. So let's go ahead and get started. The revenues, which rate do we use? Average. We're going to have an average throughout the year. Yeah, I'll see if I can. Okay, so 42. So this will be the average. I might just copy. Ooh. Cost of goods sold will be average. Most expenses average, depreciation expenses average, amortization. Okay, so everything's pretty much average. Gain, we'll get to that later. Go ahead and multiply these out. Oops. Okay. So all right, so I'm going to sum those up. All right, so 312 will be our gross profit. And in this case, it's not a composite, not yet anyways. Because those two are the same for now, it'll be gross profit will be the same. Okay, these other two. Copy. Bless you. You're allergic to this class. That's oh, wait a minute, I can't do this. I'm gonna well, it's the same. Okay. All right, so now we got this gain on sale for 814. Then we do that. Yeah, okay. So we're going to take, this is actually a historical cost. I don't have it labeled as that, but the historical cost for 814 is that. 139. So let me, by the way, if even in the handout, I believe, let me make sure I'm not lying to you guys. You guys can actually put this into a spreadsheet. It came out of a spreadsheet. So if you want to, and there's no problem with doing this, you know, you can put it into a spreadsheet and in fact, I would encourage you to do this. You know, if you want to, so you can, you know, play around with it in Excel, that's fine too. You know, it came out of a spreadsheet, so you can definitely put it back into it if you want. Okay, so this will be our net income, and this is a composite because of the gain on equipment. And we're going to transfer that down to here. So that net income is the same as this net income. Okay, retained earnings. We have to go to historical cost for that. So the beginning retained earnings, we got to go to historical cost. I'm going to give that a color. Purple. Okay, so this will be at the beginning, the first one will be the first of the year. So the historical will be this first historical of the year, this thing. Here. And by the way, so this will be, you know, for this first year, this will be the, don't do that. For the first year, this will be the first one. After this, whatever the ending is for 2026 will be the beginning of 2027. You'll just keep transferring it up, and it won't be the same, obviously. It'll be whatever the ending is and starting over. Okay, so 524, 400. Third shapes. Shapes it. Shapes it. Uh, there we go. All right. If I can just get one, I can use that one for all the rest of these. Okay, so this is the income, comes straight down. Dividends were paid on 11/1. So we have to find the historical for 11/1. Is that 145? Agree. And so this will be our ending retained earnings. And this is from 12/31/26. So this will actually next year, this will become so this will move out to be the beginning for the next year, and then we go through the whole process again. So next year, this is what we'll start with. And again, this is going to be a composite. What do you call a composite? Does it have an E on it? It does. Yes, it does. All right, so this is a composite rate. And again, next year, this will be at the top. This will be the beginning. 601, 150 will come up here, and we'll start the whole thing over again. All right, balance sheet. For the current method, this is really easy. It is what? Yep. And again, they use a current rate. The current rate is really the year-end rate. So this is the year-end. Put it here. So the current rate is really the year-end rate. And so that is what we're going to use for all the stuff on the balance sheet. At the end of the year, what is this stuff worth on the balance sheet? And again, these are still in whatever the local currency is. So these are not transferred into US dollars. These are in the local currency. So we're saying, okay, if they have cash at the end of the year of 100, what are these pounds? 110,000 pounds. Transfer that over. So it's 154. And that should be the same for all of those. There's nothing in there I don't think that's going to be. They're all the same. Yep. So these are the total assets. And we're going to do the same thing for the accounts payable. So at the end of the year, we have these liabilities, and our best estimate is that, it's going to be on 12/31, it's going to be their $1.40, just like the other stuff. So these first two are going to be the same. 128 and common stock. The common stock is going to be as of the first of the year. And by the way, for this one, we're going to keep going back to the first of 2026. Okay, and then we got the ending retained earnings. Copy this arrow. So the retained earnings is just going to come straight down here. This will be the ending retained earnings of equal. So I don't know. Probably do that differently. Here we go. And we add all this up. Now, normally, if your assets don't equal your liabilities and equity, you start looking around as to why they don't. But in this case, it's actually pretty normal. Okay, so let's see. We have total assets of, let me zoom in. Oops, too much. Okay, so we have total assets of 1,358,000. We have total liabilities and equity of 1,347,250. So we're going to take the difference between those two. I don't know. I should know the answer, but no, it's 10,000 yeah. So this is the difference. Oh, is this gonna be a gain or loss? Gain. Yep. So this will be a gain of see that one still? Oh, that's not too bad. Oh wait, I gotta turn those lights off. You don't want it. Hey, okay. So this would be a gain. I don't put it on here, but this would be a gain would go through the it was right. Oh, what was it? Yeah, this goes through the balance sheet. This goes through the equity section. This would be a comprehensive income item. So on the balance sheet, in the equity section, you would have a uh, comprehensive income item of 10,750. And by the way, this is the first year they did this. In subsequent years, you would make the adjustment to whatever it would need to be in subsequent years. So, for instance, next year, if it was 12,000, you'd take, the gain would be 10,750, 12,000 minus 10,750, whatever that would be. That would be what you'd have to add to it for the gain. You want comprehensive income. Okay, press on that. And again, so this is what we do to put it into US dollars. This would, later on, it could be, depending on how big the subsidiary is, or this foreign subsidiary is, that you would put it into um, a consolidated financial statement. Now, here's another thing, though, that's important, and that is the subsidiary itself, they don't care about any of this. This is the subsidiary's financial statement, and that's just, they're going to stay that way. They don't do anything on their end. This is only done on the parent company's end. So they're operating in their own currency. This will be their financial statement, and as far as they're concerned, this is it. They'll hand it over to the U.S. ones and say, here you go, and do whatever you need to do. But it will not change their books at all. So the US side would have to do the conversion. They may have to do conversion for the accounting rules. But then they'll also do this translation, the foreign currency translation, and then they will jam it together with their consolidated financial statements if this is a big enough part of it. Okay, let's go to the next one, which we already guessed is going to be the temporal method. Okay, so the temporal method is, why am I spacing so funny? There we go. I'm sorry. There we go. There we go. Okay. The temporal method is used when the cash flows from the subsidiary are going to be combined with the cash flows from the US company. In other words, it's going to be integral to the operations of the US company. We're not going to leave it in British pounds. We're going to take those pounds, we're going to convert into US dollars. They're going to be part of our cash flows. And that's when we're going to use this temporal method. And so this is, kind of bringing the dollars into the United States, basically. And it's going to be done for a number of reasons. Maybe the company needs it. It could be that they need the foreign cash flows in US dollars, maybe to help the US company, whatever the US company is. It could also be that they're in a country of high inflation. I doubt Britain is. They might be, though, because they actually the value of the pound is increasing. Actually, no, they'd be in deflate. But anyway, depending on what the country is, whether currency is strong or weak, you might transfer it into U.S. dollars just so you don't lose money on the translation later. If there's a high inflation rate, for instance, it might be that to not lose money on the transaction, they'll get it into U.S. dollars or even something else. You'd be getting it into euro or something. Anyway, let's go ahead and see what this looks like. So this is the temporal method. I'm going to hide the foreign currency one, which we're not going to use right now. And this one is much more involved. And it's much more involved because everything is being transferred into US dollars as it happens. That's the whole idea behind it. So, it isn't that at the end of the year, these are going to be worth a certain amount of money or something like that. It's no, this is happening ongoing throughout the year. Okay, revenues. Average. And, of course, the reason for that is that they are, throughout the year, you're going to make sales. Oops. And those sales, some will be made in January, February, March, blah, blah, blah. You get the idea. So those will be on average. Oops. Okay. Ah, we're right back where we started from. Okay, pay attention, Mark. Pay attention. Pay attention. There we go. See, you guys? All right. Cost of goods sold. Now, this is going to be different because, well, it could be different. In this case, it is going to be because they are going to be at the historical rate. So now we have to find the historical rate for the inventory. This is what we sold. So this is going to be the historical rate. Uh, that. And because the inventory will be bought at different periods during the year, or it could be anyways, that's why it could be different than the average. It could be this almost the same as the average if they, it's a very continuous operation. Okay. So this is our gross profit, and this already is a composite. Got two different rates going. Operating expenses without depreciation. Okay, so here's the ones without depreciation. We're going to take an average. So for instance, your rent, your phone bill, all that kind of stuff. Now the depreciation expense is going to be a little bit different. It's going to be at the historical. I think this is that one I think I goofed up. It's going to be at the beginning historical rate. It's going to be at this historical rate. I took it out. I should have left it. And you say, okay, why is it that way? I'll tell you why. It's because when we brought the equipment in, at that period, we brought it in at the beginning of the year. That was rate of the equipment. So these two to match, hey, how come that's different? What happened there? Oh, I know what it is. I can't do this the way I've been doing it. Okay. I can't do it the way I was doing it because these are actually linked to this spreadsheet. I'll just keep going up to the same one. Okay, so this will be that. This will be so it's whatever you have this equipment on the books for down here, that is going to be what we're going to depreciate it at. It's the same, rate. The depreciation expense along with the property, plant, and equipment is going to be the same rate. Gain on sale equipment, this one's going to be exactly the same before. 14. That purple? Purple. Oh wait, I can't do that. I gotta do this. And so this will be our net income. What's on that? And this net income will come down to here. Oops, doesn't do that. So this is the same net income. Grab something over here. Oops. Retained earnings is going to be the same thing. It's going to be the beginning. The 138. Net income it's already a composite. Actually, both these would be composites. That's a composite. This is a composite. This will be a composite. Dividends won't be a composite. This will be 11. This is actually an historical cost on the 11th. It should be on 11/1, I should say. Wait, you go. Yeah. Oh, there we go. Yeah, I just ignored it and went away. Yeah, like when your big sister's bugging you, just ignore it. Okay. So that would be, let's say, I didn't give that one a color yet. We got to give that one a color. None of this will make sense. Okay, so 145. And so this will be our ending retained earnings. Okay. And this ending retained earnings, we'll just bring that down to I think I did something wrong. It's impossible. All right. So I'm just going to put this down here. This is this retained earnings will be the same as that retained earnings. Go ahead and do that right now. Just going to make that yellow. I know. I'll do that the same thing up here. Make this yellow so that we know exactly what it is. So any retained earnings is just going to come down. This is a composite also. Okay. Rest of the stuff. All right. Oops. Let's go down here to balance sheet stuff. Cash receivables are going to be at the current rate. Yeah, I'll talk about the inventory in a second here. But let's do the easy ones first. Cash and accounts receivable. So these two will be at the current rate, which is actually the year-end rate. 140. And because those will be paid, those are in you and the most accurate dollars for the estimate of US dollars for that time at the end of the year. Inventory. Inventory is a can of worms. And here's why. You look at this and you say, okay, wait a minute, how come they show it both ways? How is that possible? And the answer is inventory that's going to be at lower cost or net realizable value would usually go in at the market rate, and inventory at cost, if it's at cost, I guess we'll put that in there just for fun. Inventory at cost would be if it's at cost. So lower of cost or net realizable. I got this wrong. The rule is lower of cost. Any inventory that's at net realizable value would be at the current. Any inventory that's at cost would be at lower cost. But this is that lower of cost or net realizable value rule. We're going to assume everything here is at historical because, well, I'm kind of lazy. So that's why we're okay. So inventory would be 141. I just did something wrong. Hold on. You guys, why don't you yell at me? Look what I did here. Historical cost. What? No, no. Okay, let me try this one more time. Equal. Why is it going all the way over for that one? Okay. Cost of goods sold, so we had a historical cost for inventory, 141. I'm going to cheat right now. I'm going to look and make sure that I didn't do something stupid again. Well, you know what? I should probably multiply these out before I. Let me get a total and then I'll see what corrections I need to make on this too. Hey, it's right. And no one is more surprised than I am. So yeah, so this will be the do me a favor though, those of you that are playing along. Let's see. This would be change this one up here if you would, unless you already knew that I was doing it wrong and put it incorrectly. Change the cost of goods sold to that, and I really do apologize for that. Actually, if you just want to just draw it, put in the right number and then just cross out whatever you have there and just put 129. It's fine. Okay. So you redo everything for it. That's right. 129.50, 129. Okay. Let's go down to accounts payable and bonds payable. Those should also be at, well, let's take a look. Those should also be at the current rate, which is really the year-end rate. Current liabilities, long-term liabilities, deferred income will be at the historical cost. Deferred income is when someone pays you cash ahead of time. So if someone paid us cash on February 3rd, we would take the historical rate on February 3rd. That would be the deferred income, because that's basically was turned into our cash, our US dollars, on February 3rd. So if it was a deferred income item, it would be a struggle. We don't have any of those, so we're just going to use the current for both of those. So common stock will be this. Common stock will be the same as we did last time. It'll always go back to the beginning. The original historical cost on the first of the year. That one. You guys want to take a break or just keep going? Keep going. All right, so let's see here. This would be difference is 4,550. Gain or loss? Loss. It's a loss because we only have 1,351,000 of assets, but we owe people 1,356. So we owe them more than we actually have, basically. And this would actually go on the income statement of the parent company. So that loss would go on the income statement of the parent company. The subsidiary would not do anything. You know, the subsidiary would just have their financial statements. But when we brought it over to the U.S. company, we would put that loss on the books as income because these are already converted into U.S. dollars. Questions? All right. Well, we're done with this one. Yeah. Let me make sure that I didn't do anything stupid. Okay, that one's right. Making sure I didn't do the first one wrong. The first one's right. Okay, good. See, I can do this, you guys. Sometimes. Okay. The rest of these I'm just going to do on the handout. Okay, let's see here. The Jill's company made a sale to Chinese buyer for 100,000 Chinese yuan. The sale was made on 12/17. At the time of the sale, the exchange rate was 15 cents US dollars for 1 yuan. So this is, notice what's happening here. We're making this sale, but it's not in US dollars. We're not going to get US dollars. We're going to get 100,000 Chinese yuan. So this is, if it was in US dollars, we just make it like anything else we had, if it was in US dollars, we just make it like any other sale in US dollars. But we're going to, so we have 100,000 yuan times, oops, times the exchange rate is 0.15 equals 15,000. So that's what we're going to put on ourselves because we're doing this on our books. This will be in US dollars. We're converting the sales to US dollars. So what would this be? What is it when someone owes you something? Yep. Accounts receivable. Now this is actually in 100 in yuan, but this is going to be an asset going up 15,000. Oops. Oh, don't do that. Don't do that either. There we go. And on the other side, they made a sale, so this will be sales, could be sales revenue. Either one's fine. In fact, I'll put both. Sales revenue, you can pick one. They mean the same thing. So right when we make the sale, this is what we're going to say. Now, again, we are not actually going to get this in US dollars. We're going to get 100,000 yuan. So this is, well, we're putting it in US dollars because that's what you do our books. That's actually not what we're receiving. So this could actually change and we'll find that it does. Okay, let's go down here. 1231. Had an exchange rate of 12 cents per one Chinese yuan. Make the journal entry. Okay, now they have not paid us the 100,000 yuan yet. So there's no cash coming in here. Well, let's see what that. Let's do the math first. 100,000 was that $12,000? So this is the yuan is getting weaker here. It's not getting as many US dollars as it was. And that could very well be by design. A lot of countries will devalue their currency because it means that more people will be employed. It'll be harder for them to buy foreign things, certainly, and it raises the cost for the people. But it also, again, causes a boom in the economy, oftentimes because their stuff is cheaper than other places, less expensive. And many countries do this. This isn't just a China thing. Many countries, and that's one of the problems that they have in Europe because everyone's using a euro, or most countries are using a euro. So it can be difficult for them to devalue their currency, even though they may want to. They say, hey, we need more employment, and what do we do? We can't devalue our currency because it's all tied together. Okay, so let's see what's going to happen here. Is this going to be a gain or a loss? Loss. Yeah, it used to be 15,000. Now it's down to 12,000. So we're going to have a loss here. I forget what I did in the handout on this one. Oh, I said translation loss. Okay, we'll go back to that. Uh-oh, I can't find my. There it is. Okay. I'm changing that just to translation loss. That's much more succinct. Of how much? 3,000. And we are not going to have accounts receivable of 15,000. We have to take out 3,000, yeah, out of that. So let's, oops. Because at year end, this is going to be an asset going down. We're not going to collect 15,000 US dollars. It's more likely we're going to collect 12,000. So we have to take 3,000 out of it. So these two together, 15,000 plus minus 3,000. That's what they owe us now. Yeah, so that will come up with the same 12,000. Okay, 121. The Chinese yuan received by Jill's company at the received exchange was 14 cents per $1. Okay, so how much do we get here? We got let's do 0.14. Okay, so this will be how much we got, and this will be converted into cash, although actually what we got here was a 100,000 yuan. But we convert that right into cash, and so this will be 14,000. Okay, what else do we do? Actually, it's going to be how much do we have in our accounts receivable right now? So they're paying off this accounts receivable.
Translation gain.
Yes, good. So I'm going to take off the accounts receivable. We're going to take off the rest of it because now they're paying it. 12,000. And yes, we'd have a translation gain of 2,000. Oops. This would be an asset going up too. Be an asset, the cash. So we get the yuan, we immediately most likely cash it in. That's what we do. We could hang on. It depends on what we're going to use it for. But we'd have this translation gain here that. So we have a translation loss of 3,000, and then we recoup some of it. Overall, the loss would be 1,000. But we had a loss of 3,000 and we recouped 2,000. And that's it. Any questions? Wow, look at that, guys. Look how early we're getting out. See? Spring break. All right. All right. Let me ask. Those of you who are, oh, that's not me, that's the board. Any questions? At home? Those of you playing along? No? Okay. Well, I'll be sending out the exams shortly. Probably in well, I don't want to make a problem, but within the hour, let's say that. Hopefully earlier than that. But anyway, if you have any questions, let me know. Oh, one more thing I was going to tell you guys. I don't know if some of you guys have accounting 305. if you have accounting 305, I'm actually doing um, a tutoring session on Fridays at noon for students that are taking accounting 305. So if you want to join that group, if you're taking accounting 305, and if you want to join, if you're doing fine in the class, then you don't need to. But if you want to, anyways, I'll send it out and send out the link for the Zoom link. So if you're taking accounting 305, yeah. Okay, yeah. So if you want to, just let me know, and I'll send you guys I'll send you the invite. I don't want to send invites to people that don't want to or are not in the class and all that kind of stuff. So anyway, but if you do want to, go ahead and send me your that you want to join, and I'll go ahead and send you guys an email. And again, it's tomorrow. It's gonna be on Fridays at noon. This is what we have so far. That might change. I hope it doesn't, but as far as tomorrow is concerned, it's going to be at noon. Any questions? So again, let me write that down. So, where's so if you want accounting, what did it say? 305? Intermediate 2? I'm going to do a tutoring session on Fridays. At noon, and that will be a Zoom meeting. So if you want to join it, or I mean, even if you just want to get it, I will definitely send it to you if you want me to send it to you, the link. If you don't, you don't have to show up if I send you the link, obviously. But if you want to, let me know and I'll send you the link. I don't want to I don't want to send it around to everybody, people that aren't taking the class or don't want to do it anyway. So anyway, if you want to do the tutoring thing on Fridays, send me an email. And my email is mtaylor49 at Roosevelt. Ooh, let's not do that. Yes, we know what you're writing, okay? The same email we have, okay? We're Roosevelt edu. So if you go ahead and send me an email, and I will include you on the list and send out the Zoom link. So that's intermediate 2. We're not going to be doing any other class at this point. If there's other class that you want to do, we can always talk about that. But anyway, tutoring tomorrow, Zoom meeting at noon if you want. I will send you the link. Okay, any questions?
Hey, Professor Taylor.
Yeah.
I just wanted to say I was in your 305 class last semester, and I had an amazing time, and I learned a lot of good things as well as
Okay.
this semester. So just wanted to give you props for that. Thank you so much.
Thank you. And I am teaching, at least right now, I'm scheduled to teach accounting 305 in the fall. I'm hoping that none of you are going to be taking it then. I hope that everyone's going to be passing it this time around. But I am teaching it in the fall right now. I currently on the schedule I'm in fall, so yeah, that could change. But anyway, yeah, thanks. Yeah.
Thank you. Have a good spring break.
All right, thanks. Any other any questions or anything? Okay, so anyway, yeah, and if you are going to join the Zoom meeting, the 305, the Zoom meeting, if you want, you send me any problems that you have ahead of time, and I can make sure that I have all the stuff there to do them. So if you do have specific problems, like I can't figure this one out or something, or I don't know, how do we remember this one or whatever, go ahead and send me a copy of it if you would ahead of time, and that way I can make sure that we cover that one and make sure that that one is did we get to it? Okay, so if you have any specific problems that you want to go over. Any other questions? Okay, well, I'll say goodbye to those of you at home and somehow, here we go. Okay.